This video will cover various types of investments. Specifically, we'll discuss short-term interest-bearing securities, often referred to as money market securities and sometimes even called cash. Why are they called cash when they're really not cash? It's an investment in securities because they're the closest thing to cash. So what we're looking at here in the first bullet is short-term interest-bearing securities are often a substitute for cash. It's a way to park your money for a short time period and earn a little bit of interest in the time being, but knowing you can get your hands back on that cash fairly quickly because these securities mature in the very near future. And not only that, but their values do not fluctuate very much, which means if you have to sell it, you're not going to be selling it at a very big discount. The second bullet here is we'll discuss derivatives, options, and futures very, very briefly. I teach a course in financial engineering that goes in depth with options and futures contracts and even swap contracts. It's really not what we want to cover in this course, but I'll touch on it briefly. And in this video, I'm going to skip equities and bonds. I'll leave it up to you to read the book on it, and you've gotten a good dose of that in the basic financial management course, and we will soon come to chapters where we're going to spend a lot of time valuing stocks and bonds. So I'm not going to reiterate that material. In a very short while in this course, we'll be covering a whole separate chapter on equities and a whole separate chapter on bonds. With that said, what I want to do is move on to money market mutual funds. I want to look at an actual money market mutual fund. Not because I want to look at money market mutual funds per se or mutual funds in general. That's coming up in a later video. In fact, a couple of videos on that. My point here is let's look at a money market mutual fund, a real live one from Vanguard. And you can find it on Vanguard.com. And in that portfolio of securities will be money market securities. And we can look at the various types, and then what I'll do is I'll move on to paper and pencil when I need to discuss, for example, repurchase agreements, better known as repos. And then I'll transition over to options and futures contracts, which will require some brief pencil work. So here we are at Vanguard's website, and I have listed here all the asset classes that Vanguard deals in. Now, Vanguard is a mutual fund complex and runs what's called a family of mutual funds. The family's kind of big. It's often 100 different mutual funds. I mean, no asset manager wants to manage just one fund. They don't get economies of scale out of it. So if you manage 100 different funds, you can use the same funds on much of the same systems that they have, and the same lawyers and the same accountants can all help out. So that's where the economies of scale kick in. So Vanguard has probably 100 funds or more, and we can look at them right here because, like I said, they're listed here by asset class. And you know how a balance sheet usually lists the most liquid assets first on the asset side, and then on the liability side, the most liquid liabilities, the ones that are coming due the fastest. They're at the very top, and as you go down, the liabilities become longer in terms of maturity. And the same with the assets. As you go down the assets, you start out with cash, then accounts receivable, and then you're down to property, plant, and equipment at the end. Well, it's kind of set up that way here. Look, here's the money market funds, right? That really what we're focusing in on. But let me just take you down, scroll down a little bit to look at the other major asset classes. So remember, asset classes describe a certain type of asset and the risk and return associated with it. So when you look at money market mutual funds, they're low risk, low return. So it's really changes in short-term interest rates that drive the risks to money market instruments and money market mutual funds. And then you go down further, you go into bonds, like here's U.S. bond funds. You're getting interest rate sensitive risk here. So the important point to remember is that intermediate and long-term bonds are subject to changes in intermediate and long-term interest rates. So that means the risk that intermediate bonds and long-term bonds face is from intermediate interest rate and long-term interest rate changes. That's the source of risk, which is a bit different than money market securities, where the main risk driver is short-term interest rates. Short-term interest rates by themselves tend to be, not always, tend to be more stable than intermediate and long-term bonds interest rates, which means the price of money market securities are relatively stable because the underlying changes in interest rates, their sensitivity is lower. And furthermore, while intermediate and long-term bonds tend to be more risky than money market securities, intermediate and long-term bonds are substantially less riskier than stocks on average. And there's lots of different types of bonds. Here we have investment grade, which is higher quality. Then we have below investment grade, often called junk, sometimes called high yield. We have tax exempt bonds. And you come down, you have balanced funds. Now these balanced funds are not really an asset class. They're just a mixture. They're literally a mixture of stocks and bonds, which is why they're called the balanced. And then we come down further. There's traditional type of stock. So let's look here. Yeah, traditional U.S. stock funds here, large cap stocks, and so on. Let's go back up to the money markets, which is where we want to look at here. Let's jump into the prime money market fund. Now, before we jump into it, let's look. Here's the ticker symbol. So if you wanted to buy this in StockTrack, you'd type in VMMXX. And then it's obviously, we're in the money market world. The expense ratio is kind of low, 0.16%. We'll talk about what the expense ratio, we'll actually compute expense ratios in a later chapter. The price now, take a look at this. This is important here. See all these, there's 3 different money market funds. They're all priced at $1, and that price stays fixed. Money market mutual funds came about in the 1970s, and they were designed and set up to compete with banks. So the idea was, you'd put $1 in a bank, you would get $1 back. Even if you were collecting interest, the interest would accumulate, but basically you'd pull out the same fixed amount that you had before. And so what happens with these money market funds is the net asset value, the price that you pay, stays fixed at $1. And then each and every day, this fund earns interest income, and then it subtracts its expenses for the day, and that little amount that's left over is declared as a dividend. So each and every day you get a small dividend that accumulates into something in the long run. But, for one day at a time, it's not very much. But that's how they keep a price fixed at $1, by declaring a dividend at the end of every single day. So let's go into this prime fund here and see what we can learn. Now here, product summary. Vanguard Prime Money Market Fund investment objective is to seek and provide current income while maintaining a stable share price of $1. As such, it is considered one of the most conservative investment options offered by Vanguard. Although the fund invests in short-term high-grade securities, the amount of income that shareholders may receive will be largely dependent on the current interest rate environment. Investors who want to have short-term savings goal and seek a competitive yield may wish to consider this option. So, investors who have a short-term savings goal and seek competitive yields may wish to consider this option. Okay, so that kind of tells you everything here. Now, going further, we see here the minimum investment's $3,000. You come down below, and here's the fund advisor, the company that actually advises and recommends buying various money market securities. And then we have here potential risk, and it tells you not only potential risk, but potential reward. On a scale of 1 to 5, this is a 1. It's low risk, low reward. What you see is what you're going to get, basically. Now, this is interesting. Look, every fund as required by the Securities and Exchange Commission has to post and disclose and show with a graph what happens to a $10,000 investment, a hypothetical $10,000 investment over the last 10 years. And so here you have this fund starting out in 2010 at $10,000. And by the time 10 years rolls around, you'd have $10,656.52. Notice what's happened. This fund, first of all, you see the compounding that's taking place, but almost no compounding took place for about the first 5 years. That's because the Federal Reserve kept interest rates really low. So remember, back in the product description we looked at, this thing is mainly driven by interest rates. And so interest rates went up, and so this money market mutual fund keeps buying short-term securities, and they keep rolling them over and rolling them over. Well, they've rolled them over in the higher interest rate securities over time. And starting around 2015, the interest rate started to pick up. So people got a better return out of the fund. So here you see it ramping up. And now notice what's happened. It's flattened out. Now, it flattened out for two reasons. One, the Federal Reserve, long before the coronavirus hit, started to lower interest rates. And then the coronavirus hit, the Fed dropped interest rates to the floor again. They're basically at zero. So this line is going to flatten out for the next couple of years, just like it did earlier on in the early 2010, 11, 12 area. It's going to flatten out because the Fed has told us they expect to keep interest rates basically near zero for the intermediate term. Now, what we're really interested in here is the portfolio composition. And so here we have the portfolio composition as of June 30th of 2020. Here's the various types of money market instruments that could be in this fund. And so here it lists bankers' acceptances. We're not going to cover those, and it doesn't much matter here. There's zero weight here anyway. But we're not going to cover them because that's usually covered in an international finance course, because bankers' acceptances are for international trade. They support international trade. Now, the next line is certificates of deposit. Well, those are kind of like the CDs you and I would buy at a bank. So we go to a bank, we want to lock up our money for 6 months, a year, 2 years. Again, the point is the point here is you lock your money up for a couple of years, you get a better rate out of a bank. But, these are certificates of deposit. They kind of work the same way, except they are different. They're negotiable CDs. And what that means is these are jumbo CDs. They could be $100,000 to $1 million or more, and they're tradable amongst institutional investors. Now, the difference is between you and I go to the bank, we open up a CD, we lock our money up for a couple of years, we get basically a receipt that tells us we deposited the money. But you know what? We can't trade that receipt. We can't trade it because it's a retail CD. Negotiable CDs are institutional level CDs that can be bought and sold in the market. And so here we have a mutual fund, a money market mutual fund that invested 2% of its money in the fund. Well, how much money is in the fund? Well, the net assets, which are assets minus liabilities, is about 127 billion here on the right. Okay. And by the way, look at here, they have 302 holdings of securities. The average maturity is 52 days. Now, generally, money market securities are 1 year or less in maturity. And so here they got pretty short-term maturity, only 52 days. And then they got a weighted average life of 83 days. So let's continue. They got other, which are not really specifying. And then there's repurchase agreements. Now, at zero here, I want to cover those because they're an important component of this course for short-term interest rates. And so you'll often find on various money market mutual funds and even regular mutual funds that invest in stocks and bonds, they need a little liquidity. So they enter into repurchase agreements. Banks do repurchase agreements. Securities dealers do repurchase agreements. And even the Federal Reserve Bank in New York does repurchase agreements to help manage the money supply. So I'm going to cover that, but it takes paper and pencil to cover that concept. So hold on. Now there's some commercial paper here. It's small, but commercial paper is important. Commercial paper is debt that's issued by large companies that are well known. And so there's usually no collateral underneath them. So you're basically lending money to companies like General Electric and Ford and General Motors based on their credit worthiness and the fact that you know them and that they're large companies. And so what's important about this is it's very convenient for companies to borrow money on the fly. So companies frequently need money. They're constantly turning money over. And things come due, they need to borrow money for their cash purposes. Well, if you issue a bond, for example, like say a 1-year bond, a 2-year bond, 5-year, 30-year. You know how long it takes a company to put that registration statement together and get the attorneys and the accountants together to hammer out a fair and equitable bond? It takes a very long time. By the time you do that, interest rates may have changed. You've already been on a liquidity squeeze. It just doesn't really work if you need money in the pinch. Well, here comes the commercial paper market. The commercial paper market is designed so that companies can issue debt like instantaneously, nearly instantaneously. And what they do is they file arrangements with the Securities and Exchange Commission ahead of time. And what they can do is if they issue debt that's less than 270 days in maturity, they can issue it on the fly. And it's institutional investors that are buying it. It's not like the public's buying these things because these are multi-million-dollar deals. So commercial paper is extraordinarily convenient in the world of finance for liquidity purposes. It allows companies to borrow money without collateral, and that's an important point. Without collateral, if you have to attach collateral like a building, it would be kind of difficult and time-consuming. Now let's look at other money market securities here. U.S. government obligations. Those are very short-term government debt that's issued. Treasury bills are U.S. debt that's issued a very short-term maturity. And then here's Yankee foreign, and that basically means they've invested in some foreign money market securities that are issued in the United States. They're issued by foreign companies in the United States. Like could be issued by Toyota, for example. And so there it is, Yankee/foreign. That adds up to 100%. So what we want to do now is we're going to move over to paper and pencil. I'll discuss repurchase agreements, and then we'll move on to options and futures contracts. Okay, so what we want to do here is look at repurchase agreements. We'll cover these types of transactions, which are important because they're used throughout the financial economy. And then we'll look a little bit more at commercial paper that we discussed earlier. I can give you some more context and a better understanding of it on paper. So let's look first at repos. And repos stands for repurchase agreement. It's short for repurchase agreement. Now, here's the setup. Here's the motivation for it. There's a borrower and there's a lender. Now, this borrower has collateral but needs funds. Okay? It has very liquid collateral but has funds, like a securities dealer. Securities dealer buys, say, money market securities, and then but then how does it actually fund that? How does it actually get the cash to buy it? Well, here's a situation. So you got a security dealer that has collateral but needs money, cash, right now. You have a lender with excess cash and is looking for a return because the lender just doesn't want to sit on cash, literally cash, because there's no return to it. In fact, it's a negative return because inflation will eat away at it. So that's the setup here. So what happens is the borrower and the lender here find each other in the markets, and they're usually doing these transactions on a daily basis. So it's not like they're scratching their heads and trying to figure out, well, where am I going to find somebody to lend me money? So and where am I going to lend money? These guys know each other. They're very familiar with each other. These transactions happen all the time. So now what's going to happen is with this transaction, there's going to be what's called a first leg of the transaction. And so what happens is, let's say that the collateral is a T-bill. The collateral is going to go over to the lender because the lender is not going to lend money without collateral. And then at the same time, money is going to go over to the borrower. So the borrower gets the money. The borrower doesn't need the T-bill for the moment, and the lender holds it. So there it is. We have a secured transaction. Okay. Now, the second part of the leg is this. And by the way, the second part of the leg is the unwinding of this repo. And the moment they enter into this first leg and they enter into this entire transaction, they've entered into a mechanism to unwind it at the same time. So when they enter into the first leg, they know either the next day or maybe a couple days later, a week later, this is going to unwind. And when it unwinds, the treasury bill is going to go this way. Treasury bill is going to come back to the borrower. And the borrower is going to give up money plus interest. Yeah, it's interest there. And so the lender's happy because they have the interest income they were looking for, right? The borrower is going to have interest expense. And the borrower gets the T-bill back. So notice what's going on here and why this is called a repo or a repurchase agreement. And I'm talking here also, it's kind of funny, I'm talking about a borrower and a lender. So I'm talking about borrowing and lending money, and I'm talking about repurchase, which kind of implies a sale. Well, look at this transaction. You can look at this as a secured borrowing using the collateral because money's going back. You can look at it, this first leg, as a loan, but you can also look at this transaction of the first leg as a sale of a treasury bill, and the lender is buying it, okay, and giving the borrower money. Okay? And then what happens is on the second leg, the next day, the transaction unwinds and the borrower repurchases the T-bill that they sold in this transaction, in this component right here. So now you can see why there's a borrower and a lender, and there's the idea of repurchase, which kind of suggests that there was a sale. So this is what's used by security dealers. So here's security dealers that have a security and want the money, and the lender could be also another security dealer or simply another financial institution that has excess cash. And sometimes security dealers end up with excess cash on their hands temporarily before they buy the next lot of securities. So one more thing, while this lender could be a securities dealer, let's tie this back to money market funds that we were just looking at. Well, here, this lender, this could be a money market mutual fund, and they invest in a repo. And what's going to happen is they're going to earn interest income from that repo, okay? Because it's an asset that earns interest income. And what's going to happen is they're going to give up cash that they get. And where are they getting the cash from? That's investors like you and I. Investors in money market mutual fund. They invest. They're basically shareholders in effect. They're equity holders, right? They fund this. They give cash. So there's an increase in equity. Then what happens is cash goes up by the same amount. And then the money market mutual fund gets rid of the cash and buys a repo in its place. And so now it can have a whole series of repurchase agreements down here on the asset side. And that money, right, this income that's being generated here, minus expenses, will end up going to the equity holders. Now, a similar story is happening with commercial paper. So let me give you a little bit of context on commercial paper. Let's say you got a large corporation. Let's say it's General Motors. General Motors will issue commercial paper, and so it's a liability. It's short-term commercial paper. It's not secured by any asset here on this side. So this is unsecured, typically unsecured debt. So General Motors could issue, let's just say $1,000 in commercial paper, and that commercial paper gives them cash of $1,000, and they use this cash to fund their inventory. They're buying all the material needed for the construction and the building of a car, and so that's where they're getting their short-term cash flow from. So think about it. You wouldn't want to, in this situation, you wouldn't want to borrow money long-term for like 10 years or 20 years to finance the buying of inventory for your automobile production. Because General Motors buys that inventory, they turn it around pretty quickly. So they get that inventory and they spend that money, and they take all that raw material, translate it into a car, and then they sell the car and they get their money back. So the best way to fund this is not through long-term debt, because what happens if the economy shrinks down and there's hardly any sales? then you don't want to have this gigantic long-term debt sitting here with no activity happening on the other side. There's no production of cars. So what General Motors will do is they'll borrow short-term to fund the short-term needs they have for that inventory. And when the cars get sold, they pay back the commercial paper. And remember, commercial paper is under 270 days. It doesn't take 270 days to build a car. So whatever their maturity is, it's kind of low, short. And so it kind of works out properly in terms of maturity-wise, in terms of timing. Borrow short-term, right? Borrow short-term to fund short-term needs. And then if you hit a recession and things and the economy shrinks down and you stop producing cars, well, you're not going to be buying much inventory anymore. You're not going to need much commercial paper. The commercial paper will mature. So it kind of makes sense. The same type of concept happens with shadow banking. Shadow banking are banks that are not monitored and supervised by the Federal Reserve or the FDIC. They're called shadow bank. And basically what these guys do is the shadow banking is often related to mortgage securities. And so what happens is these shadow banks can issue commercial paper. Here, if they're well known, they issue commercial paper for a certain amount of money. They get the cash. And what do they do with this cash? Well, they translate this cash into mortgages. They buy mortgages. And what do they do with the mortgages? They assemble them and bundle them into packages and sell them as bonds, mortgage-backed securities. And so they buy mortgages, but to bundle them into a bond takes a lot of paperwork and a lot of time and effort. I mean, within a month or so they get that done. Well, they bundle these mortgage-backed securities. They sell the mortgage-backed securities, so they go away. They get cash, and they use to pay off the commercial paper. And then the whole thing starts over again. So shadow bank makes money by buying mortgages from banks, packaging them, and selling them as bonds, which we'll look at a little later, mortgage-backed securities. So how do they fund the buying of those mortgages? They only need the money for a little bit of time because it may take a month for them to process and bundle all those mortgages into a multi-million-dollar or multi-billion-dollar mortgage-backed security. Well, they fund it with commercial paper in the short run. So now don't lose sight of where we are in this video. Well, the point is I want to make, look, you have a money market mutual fund. Investors send their money into the fund. You become an equity holder of the fund here. So this is the equity component. They give the money market mutual fund cash. The money market mutual fund turns that cash into repos, commercial paper. They could buy T-bills directly, and so on. And so all these assets here generate income, interest income, that minus expenses goes back to the equity holders like you and I. And that's how we make a little bit of income from our savings. Let me cover options briefly. There's two main types of options. There's call options and there's put options. Call options give you the right to buy 100 shares of stock through its expiration date. And the price at which you can buy the stock is known as the strike, often denoted as X. It's sometimes called the exercise price, sometimes called the strike price. So when you purchase this call option, it gives you the right but not the obligation, meaning you don't have to. That's why it's an option, to buy the stock at X. What you hope is the stock, so if you graph the stock price here, so we'll call it S for stock price. And so here's X, let's say it's $25. You hope that the stock before expiration of this option is higher than 25 because you're going to make the difference between S, whatever this price is, and $25. That's your payoff to the option. So you're going to be bullish when you buy a call option. And what's interesting about call options is you pay a premium to buy this call option. It's usually nowhere near the price of $25 or where the stock price is. The call option is substantially less because, look, your payoff is S, the stock price, minus a whole $25 backed out of there. So therefore, you're going to find a premium on the premium associated. This could be $1 or $2. So for $1 or $2 per share, maybe $3 per share, you can control a stock. Instead of spending $20, $30 for a stock, all you have to do is spend $1, $2, $3 on the premium, and you can control 100 shares of stock, and you can buy it at 25, provided it goes above 25. Now here's the catch. If the stock by maturity is below 25, you lose your entire premium. You paid that $1 or $2 or $3 that you paid. Gone. You lost 100% of your investment in the option. Okay, so you can buy the option independent of the stock. Now that said, options are derivatives. So in other words, this call option, it has a value, and that's what the premium is. The premium is what you're going to have to pay. That's the value. So you're paying a premium of $1, $2, or $3. That value for the call only is only covering a short period of time depending on when the option matures. So most options mature within a couple of months, which means you pay a premium on the call, you buy the call lasts a couple of months and then basically dissolves, disappears. And how does it dissolve or disappear? Well, you could exercise it and buy the stock at 25 when it's what we call in the money, right? Or you can just let it expire, and it expires worthless, and that's where you lose your entire premium because the stock fell below 25. You never want to exercise this option. Buy the stock at 25 when in the open market the stock sells at below 25. You might as well just go buy the stock in the open market at a price below 25 rather than paying the higher price. So my whole point of this story is call options last a period of time, several months usually or less, and you are bullish when you buy a call option. You're bullish on the underlying stock. The call derives its value from the underlying stock, and that's, again, options are derivatives. So when you look at derivatives derive their value from some other underlying asset. So with a call and a put, they derive their value based on some underlying stock that they're written on. Now, for a put, you get a right to sell 100 shares of stock over a certain time period, and the price that you sell is X, the strike. And you expect the stock, when you buy a put, you expect the stock to drop. So you make money here in this area. So let me redraw it here. So here we have X equals 25. Okay, we'll use an option with the same strike. Here's the stock price. And when the stock ends up below 25, that's when you want to exercise the option. That's when it really has value because you get to sell the stock for 25. See the plus side here. And when you sell the stock at 25, you have to give up the stock. So you got to give up the stock here, and so there's a minus sign. So you have to go in the open market, buy the stock for S, but you're selling it at 25. Well, it's going to be positive if the stock is below the strike price. Here, when you buy a call option, you're going to pay $25. See this minus sign? You're going to pay $25, and what are you going to get? You're going to get the stock. Here, you're getting $25, and you're giving up the stock with the put. So the whole point of this is there are derivatives out there that derive their value from other assets. Calls give you optionality. Puts give you optionality. Calls are for when you're bullish on a stock, and puts are when you're bearish. And you can get lots of leverage because the premiums are often substantially less than the actual stock price. Because here, look, you're backing out $25. So you're really paying a price based on this difference because that's the potential payoff. And the same thing goes here. You're actually paying a price based on this difference, not just on the stock price. So a call is an alternative for buying a stock long, and a put is an alternative to shorting a stock. Now, with that said, let's move on to futures contracts. Futures. Futures are another form of derivative, and you can go long futures contracts and you can go short futures contracts. Now, what's interesting about futures contracts is once you enter one of these contracts, you're obligated to fulfill the contract. There's no optionality here. You have to go through with it. So when you go long a futures contract, you expect the underlying to go up. And if you short a futures contract, you expect the underlying to go down. So when you're long a futures contract, you have to buy the underlying asset at the futures price. So when you enter into a futures contract, you're going to pay, call it FP, a futures price. You're going to pay this futures price. You're not going to pay for it now. You're going to pay for it in the future. So how these things work, let me compare it, for example, to something you're used to. You go to a gas station, for example, and you have cash in your pocket, and you go and you buy gas. Right there on the spot, you're getting gas in your tank, and you're giving up cash. That's called spot. Right on the spot, you're getting possession of the underlying asset, and you're giving up cash. In a futures contract, you enter into an agreement to buy or sell in the future, not right now. So with the gasoline example, what if you could agree with your gasoline station that in 6 months from now, you're going to buy gas at $3 a gallon. And you're obligated to buy the gas at $3 a gallon for a full tank. That would be basically a futures contract. Home heating oil companies will send you in the mail an invitation to enter into a futures contract to buy home heating oil at a fixed price during the winter. So normally early in the fall, you'll get this notice in the mail from the home heating oil company. Buy heating oil at this price fixed throughout the winter. And what happens is you're locking in the price now. Now, the thing is, there's always downside risk to these. There's upside risk and there's downside risk because you're obligated to fulfill this contract. You're obligated to buy the gasoline or the home heating oil at the fixed price. Now, if the actual price 6 months from now or during the winter turns out to be really, really high, you're glad that you locked in this futures price. Because it goes, if oil skyrockets or the price of gasoline skyrockets, you get to buy it at this low fixed price, futures price that you entered into. Okay, yeah, that's if you're long the position. Now, if the price of gasoline or home heating oil is really low, right, and you locked in this futures price, which is kind of high, you're kicking yourself that you entered into the contract. You still have to fulfill the contract. It's just worked against you and you're going to have a loss. So when you're long a futures contract, you've entered into agreement to buy a commodity in the future, not now, in the future. And you hope that the underlying asset goes way up in value because you've basically locked in this low futures price. So to put a dollar amount to it, let's say you locked in, let's use the gasoline example. You contract with your gasoline station. Just suppose you could do this. You contract your gasoline station to buy gas at $3 a gallon, and in 6 months from now, and in 6 months from now, gasoline's at $3.50. Well, you just made 50 cents a gallon because you're only paying $3 for it. Now, if gasoline goes down to $2 in 6 months from now, you're kicking yourself because you're paying $3 when it's only worth $2. You're losing $1. You're overpaying by $1. Now, with a short position, it's in a contract. It's a futures contract. You enter in to sell something in the future. Okay? You're selling in the future, so you hope that the underlying asset goes down in value, okay? Because you want to lock in and sell it at a futures price that's high right now. And then when the contract matures, you hope that the underlying asset drops in value so that you sell it at this high price. And so how do you sell it at the high price? Well, you're selling it to somebody. Well, you go into the open market and you buy it at the low price, turn around and sell it at the high price. So your profit would be futures price minus, let's just call it a stock. Let's say it's a stock price. This would be your profit on a short position. On a long position, it would be the stock price minus the futures price. So now you can enter into futures contracts on individual stocks. They're not that popular in the world. Futures contracts are really popular for indexes. So you can go long or short the Dow, the S&P, for example, depending on whether or not you're bullish or bearish on the underlying. Now, so that's basically an introduction to futures contracts. Back to options. What's cool about options in terms of portfolio management is that, look, when you know, right now, let's suppose you think, well, I think the stock market's going to drop dramatically. I don't want to unwind my entire position, all my stocks, my portfolio. I could be wrong. The transactions cost will be quite high. So you know what you can do? You can enter into a put option on something like the S&P 500 or the Dow or the NASDAQ, an index, stock index. And what you can do is you can use that as portfolio insurance, because if the market does drop, your portfolio value, all else being equal, is going to drop dramatically. But what happens if you add a put on top of it? So you have this entire portfolio, plus you buy a put, and the put is designed to pay off when the market goes down. So the market tanks, your stock drops in value, your portfolio is in the tank, but your put pays off. So to review, your portfolio drops, your put offsets, and then your overall gain or loss is relatively unchanged because you've insured your portfolio using portfolio insurance, using a put as portfolio insurance. So it's a pretty cool thing to do. But the point is here, insurance costs you money. You can insure your portfolio for several months using these puts, but you're going to have to pay a premium per share. And if you're wrong, by the time you're done, the 3 months or 6 months or whatever the time period is, if you're wrong, then you've paid this insurance premium and you didn't have to use it. It's basically what you do every time you buy auto insurance and house insurance. If you don't get into an accident and your house doesn't burn down and you don't have any problems, you've paid an insurance premium, but it didn't really pay off, so to speak, because, luckily you didn't have an accident. So you can buy calls and puts on StockTrack, and you can enter into futures contracts in StockTrack. Now, I'm giving you a brief summary of these concepts. I spend the whole course on it. It takes quite a while to unpack all of this information, to provide examples and graphs. So I don't expect you to know this in detail. But the point is, you can trade these in StockTrack. And if you have a question on it, on how to implement it, you can always send me an email or give me a call or stop me in class. And I'll explain how to put it on with your particular portfolio and your particular situation.